Hello, America. I'm Kimil Chandler, and this is Qualitative Listening. Let's go over the yields as of April 10th. The 3-month is at 4.3%. The 6-month is at 4.17%. The 2-year is at 3.85%. The 5-year is at 4.04%. And the popular 10-year is at 4.4%. The 30-year is at 4.86%. As we all know, bonds are a safe place to invest in during these times, but today I have positive news for you. Inflation has cooled this month. In March 2025, the U.S. inflation cooled unexpectedly, with the Consumer Price Index declining by 0.1%. The first monthly decrease since May 2020. This brought the annual inflation rate down to 2.4%, a significant drop from February's 2.8%. What's causing this? Let's go over it. Easing supply chain constraints. Improvements in global supply chains have started to elevate some of the earlier pressures that drove up the cost of imported goods and commodities. With disruptions and more stable inventories, companies have faced lower upward price pressures. Next, shifts in consumer spending. There has been a noticeable movement in consumer behavior. Rather than rapid spending on goods, a factor that tended to drive prices higher, consumers have been shifting more towards services. This change in the mix of consumption can moderate inflationary pressures, as the pricing dynamics in services tend to be less volatile than those for goods. 3. Tariff policy concerns and adjustments. The headline from Politico noted that tariff concerns were in the backdrop. Anticipation of further regulatory adjustments or even potential modifications to tariff structures might have led businesses to preemptively adjust pricing strategies. In some cases, this meant absorbing costs rather than passing them on fully to consumers, thereby softening the inflation rate read. Next, monetary policy factors. The central bank's stance on tightening monetary policy has also contributed indirectly to the moderation in inflation. Market participants expecting a more cautious or restrictive monetary stance may have adjusted their price. This, in turn, has tempered wage and price increases in various sectors of the economy. Next, temporary base effects. Some analysts point to the possibility of base effects playing a role. When inflation rates are calculated on a year-on-year basis, a period of exceptionally high prices in the preceding year can make the current year's figures appear lower, even if underlying trends remain robust. In March 2025, such statistical factors may have contributed to the reported slowdown. In summary, it appears that improvements in supply chain logistics, shifts in consumer spending behaviors, anticipatory adjustments in response to tariff policies, and a more cautious monetary policy environment have all played parts in the cooling of inflation. These factors combine to create a more subdued inflationary trend during March 2025. However, it's important to note that while March saw a cooling in inflation, new tariffs introduced in April are expected to reverse this trend. Economists warn that these tariffs could lead to increased costs for businesses and consumers, potentially driving inflation higher in the coming months. That's the show, folks. Thanks for listening to Qualitative Listening.